where a company's entire stock market value, well, you pay to buy all of it, is actually less than the cash and crypto they just have sitting in their treasury.
You're buying the whole operation.
Exactly. And the liquid assets inside are worth more than the sticker price.
That's the mind-bending premise we're tackling today. It's all about KULR Technology Group, or KULR. And we're using an analysis report that basically argues its current valuation is fundamentally mispriced.
So our mission here is to really dissect the mechanics of this anomaly.
Yeah, what the street calls negative enterprise value. We need to figure out if this is the rare bargain of 2026 or if, the market is pricing in some kind of hidden flaw.
We have to start with the numbers because this whole thesis rests on them. As of today, KULR's stock price is sitting right around $2.96 per share. And that gives the company a total market capitalization of about $135 million. So that's the cost to buy the entire business. $135 million. Okay, here's where it gets really interesting and why that number is so perplexing. The core of this argument is all about their assets. And we're not talking about factories or IP yet, just liquid assets.
Right. We need to zoom in on their treasury. The analysis report highlights this massive non-operational asset base. It's pretty unusual for a tech company that's scaling.
What's that?
Well, first, they hold a significant amount of Bitcoin. It's valued at approximately $120 million. And second, they have traditional cash on hand totaling over $20 million.
Okay, so if we just do the simple math on that, $120 million in Bitcoin plus $20 million in cash, we get to $140 million in total liquid assets.
$140 million, which is $5 million more than its entire market cap. Precisely. And that is the definition of negative enterprise value. Enterprise value is, usually calculated by taking the market cap, adding debt, and subtracting cash. It's meant to show the true cost of the business itself. When your assets are more than your market cap, the EV goes negative.
So let's just translate that. I want to make sure we're being clear. If the company costs $135 million to buy, but you get $140 million in assets with it, you're basically buying $1 for 96 cents.
Exactly. But you're not just buying a pool of cash, you're buying a company that has a core operating business.
So for you, the listener, this means two things.
Right. First, you get the treasury, the Bitcoin and cash, at a discount. And second, you're effectively getting the actual thermal management business, which is KULR's whole engine, for free. It's an immediate asset floor backing the stock price. It's a huge safety net.
That safety net sounds comforting, but I have to ask, $120 million of that is in Bitcoin. That's not exactly stable cash. It introduces massive volatility. Does the report address that risk? How quickly could that floor just disappear?
That's a critical question. And yes, the analysis acknowledges that right away. It emphasizes this is a very active decision by management to use Bitcoin as a primary reserve asset. The floor is real today, for sure, but it does expose the company's value to macro crypto swings.
So what's the counterargument?
The report points out the sheer size of the holding. It's so large relative to the market cap that even a big drop in Bitcoin would likely still leave that EV floor intact, just a bit lower. Management is clearly banking on Bitcoin appreciation to boost the balance sheet, not just hold it steady.
So it's a high-risk, high-reward treasury strategy.
Yeah.
But people aren't buying KULR just to get a discounted Bitcoin fund. That liquidity is a cushion, but the real upside has to come from the core business.
Let's talk about the engine that's generating that triple-digit revenue growth. Yes, we absolutely have to shift to the core technology now. This is the driver of their real potential. KULR specializes in thermal management. Their main thing is preventing what's called thermal runaway.
That's when batteries overheat and
catch fire or explode. Think high-density batteries like in EVs or data centers. They stop that from happening.
So this isn't just about making things run a little cooler. It's about solving a fundamental physics problem. I mean, heat is the ultimate bottleneck in modern tech. The more power you use, the more heat you create. So where is this demand coming from that's making their tech so critical right now?
It's coming from sectors where failure is not an option. Historically, they've worked with NASA, which, needs the highest safety standards possible. But the explosive growth now is being driven by two main sectors, EVs and, critically, AI data centers.
Okay, let's slow down on the AI data center angle. We hear a lot about AI chips, but why does that specifically create a 116% revenue problem for a company like KULR to solve?
Think about the power consumption. Running these massive AI models takes just an astronomical amount of energy. Data centers need huge battery backups. And as the processors get denser and hotter, traditional cooling just can't keep up. KULR's tech manages that intense heat and, most importantly, provides safety against fires in those enormous, expensive battery banks.
And we can actually see the results of this in their numbers, right? This isn't just a story, it's realized growth.
Absolutely. The scale of their product demand is undeniable. In Q3 2025, Revenue was up a staggering 116% year over year. It hit $6.88 million.
And product sales.
More than doubled in that same period. This isn't just slow scaling. This is the sign of a company whose tech has hit a major inflection point.
So just to recap where we are, we have a company that's trading for less than its liquid assets, with a huge Bitcoin treasury as a safety floor, and a core business that just grew revenue by 116% because it's solving a huge problem for the AI revolution.
Exactly.
So, why on earth is the stock price down at $2.96? That combination just doesn't seem to add up. It suggests there's this serious bear trap here.
Right.
The analysis report highlights two big issues.
Right. The first major hurdle is compressed margins. While revenue grew like crazy, the company was not as profitable as it used to be. Their gross margin dropped significantly. It fell recently to just 9%.
Wait, 9%? That's brutal. The report said they used to be operating with margins over 70%. Dropping from 70 down to 9 sounds almost unsustainable.
It is alarming, and the report gets into the context. The company made a very deliberate trade-off. They spent heavily to scale up, to buy inventory, and expand production to meet that 116% demand increase. It was a choice. Sacrifice short-term profit margins for the long-term ability to handle massive contracts.
And does the analysis say if that was a necessary evil, or did they just overspend?
The consensus seems to be that it was necessary. The report suggests that to win these big AI data center clients, you have to have the capacity ready to go. If you can't fill the huge order, the contract goes somewhere else. They had to spend now to grow. The big question now is whether those margins start to recover.
That definitely puts a lot of pressure on management. Let's move to the second risk, which is maybe more about market psychology. Dilution fears.
Yes. For a while, investors were worried KULR would just keep selling stock to fund their asset buying, specifically using these at-the-market, or ATM, offerings to buy more Bitcoin. An ATM just constantly trickles new shares into the market, and it waters down the value for existing shareholders.
A classic investor frustration. But this is where the story shifts, right? What's fascinating here is that in December 2025, KULR voluntarily paused its ATM offering. They just stopped the dilution.
That action sends a very powerful signal from management. Think about it. If they thought $2.96 was a fair price, or if they were desperate for cash, they would keep the ATM running. By pausing it, they're basically telling the market, we think our stock is too cheap to sell right now.
So they're betting on their own operational growth to fund things from here on out.
That's the signal. They're confident enough in that 116% growth to fund future scaling organically, not through more dilution.
But a skeptic would say that pause could just be temporary. And we still have to talk about the broader risks for a small cap stock like this.
Of course. Even with $20 million in cash, the report notes that cash burn is still active. That's normal for a company growing this fast. And you have general market volatility. Plus, remember that Bitcoin treasury is a double-edged sword. It's a floor when things are good, but it's a source of rapid erosion if the crypto markets turn south.
So the volatility, the low margins, and the history of dilution, that's clearly what's kept big money on the sidelines. Well, what about Wall Street? Is sentiment starting to change?
It appears so. The analyst outlook is quite bullish. The consensus rating right now is a strong buy, with some price targets reaching as high as $8 a share.
$8 from a current price of $2.96. That's over a 160% potential upside. That suggests the analysts see a very clear path for the stock to close that gap.
But this raises an important point, which helps explain the skepticism. Currently, there's only one major analyst officially covering the stock.
Oh, just one?
Just one. And when you have such low institutional coverage, a stock can stay volatile and, sort of undiscovered no matter how strong the numbers look.
So what does this all mean then? How do we put all these pieces together? We've got explosive growth versus compressed margins and a solid asset floor versus the risk of low analyst coverage.
I think the bottom line thesis is that KULR offers a really unique asymmetrical double play. You get bullish exposure to Bitcoin, which is acting as that safety net, that floor limiting your downside. And at the same time, you get this uncapped upside potential tied directly to the AI infrastructure boom. The downside seems capped by the treasury, which makes buying the core 116% growth business a speculative play, but one that effectively has no acquisition price. It's very rare.
And that's really the core of it. KULR is trading at a discount to its liquid assets, basically giving the market its high-growth thermal management business for free.
Which brings us to the final provocative thought for you to consider. The company very publicly stopped selling stock via its ATM in December 2025. Now, given that they are dealing with serious margin compression and heavy spending, a situation that usually requires more cash, the question for you is this. Does that pause truly confirm that management sees $2.96 as the floor? Do they believe future scaling will come purely from profitable growth? Or is the pause just a temporary tactic to calm the market down before they turn the ATM back on later? It's something to think about as you follow the thermal management space and watch their margins in the coming quarters.